to Nirmal and Hiral, Dadia. We have Punita Kumar Sinha, founder Pacific Paradigm Advisors, joining in. Punita, as we know, you've been, actually held up in Boston right now. Firstly, how are you actually holding up there away from India?
Yeah, it's been an interesting experience. I think earlier months it felt a little scary because India was doing relatively better in terms of the COVID spread compared to the US, and US was seeing a lot of increase in COVID cases. But now things have actually reversed. US is beginning to flatten out. The number of cases have reduced in terms of daily numbers, and also the hospitals, the capacity now has been added. So the hospital utilizations have declined, and there are rooms and beds available now for patients. So I think the system now here is working much better, and things are beginning to open up. Whereas in India, we're now beginning to see the number of cases really rapidly rising and the hospital capacity getting pushed to its fullest. And so I think there is that element of more COVID cases and potentially further pain in India still ahead of us.
Right. And I think, I was just reading a couple of quotes from John Hopkins, BCG, and all of them, Punita, have been actually indicating that probably June, July are the months where we could see a peak coming in with regards to India, and then a possible spike or a relapse, if you could call so, in the month of September, October. Now, if that is the situation, how would you actually relate it to markets? Because we have seen the impact of COVID on economies across. Where would you then place India? Because last couple of sessions, in fact, last 1 month from March, lows itself, we have seen a good up move.
Yeah, actually, it's quite strange that the markets have really rallied in the face of still a lot of economic pain that's ahead of us. Right now, most countries and governments have provided a lot of stimulus, and that stimulus and liquidity is helping the sentiment positively. Now, in the US, for instance, we are not only have we had COVID, we've also having racial tensions. And so it's like a perfect storm. We are having a lot of issues, and yet the equity markets are going up on liquidity. And I think that at some point, the reality of what's happening to the economic data is going to impact this positive sentiment. I mean, unemployment is now pretty much at all-time highs. We were a full employment economy in the US, and we've gone to very, very high unemployment. So I think the demand side will start to show some pain in the year ahead, and the economies globally are the data that's going to come out over the next quarter and the next few quarters isn't going to look good. So I suspect that at that point, we may see a correction in the markets unless the correction happens before that.
Right. But Punita, any reason you're picking up right now as to why have we rallied like this since March lows? Because now if you see the levels, at least in terms of Indian markets, in fact, even in terms of US markets, Indian markets, we're just around 20% away from this year's high that we'd already seen. And similarly, if you see in terms of what's happening with US markets as well, in terms of Dow, S&P, again, we're not very far away. The kind of recovery that has come in has been spectacular. So any reason that you're picking up?
No, I think it's purely just liquidity driven rallies. I think that, if you look at history in previous kind of pandemics or economic crises, the markets have fallen a lot more than we've seen this time. Of course, the markets fell very sharply in just a period of a month, and that was different than what we've seen in the previous crises, where markets, take more than a year or so to bottom out, and we've also had a very sharp recovery. So this crisis is a little different than the previous crises, but the economic impact of this crisis could be quite high, at least for the next 12 months. And I do think that we will see volatility ahead of us, unless a vaccine comes along fairly soon or a cure comes along fairly soon, at which point then the COVID will be behind us and the economies will resume their normal activity. And at that point, yes, all markets will look good.
Right. And with all of this, if you talk about the stimulus as well, because that was one of the most important things that was required in this phase of, the pandemic. Now, India, if you go to see, is at the lowest end if you have to compare it to as a percentage of the GDP. What would you make of this number? Do you think it's enough for a market like India, or do you think something more needs to be done to get that revival in place?
Well, if you look at even the countries and the markets which have fared the best in this environment are the ones that have the most amount of money and the resources and are in the best position. So, for instance, US, China, Japan, Germany, these are the markets which have fallen the least now from their highs. They're only down less than 10%, whereas India is down a lot more. And in fact, even in May, as most of the markets rallied, India has underperformed other emerging markets. Other than the larger one, Brazil is done worse than India, but India's has relatively underperformed the EM index and also underperformed a lot of the developed markets. And part of the reason is that our fiscal stimulus is not as high. India doesn't have quite the resources that a US or a China have. And then in countries like Japan and Germany, the COVID is a little bit more under control. And in India, given the sheer population, it's going to be very difficult to not prevent community spread. And so the numbers will keep rising. And therefore, there will be more and more containment zones potentially going forward. So I think the economic impact of that could be quite severe, and the fiscal stimulus isn't as high as what we've seen in some of the other economies.
Right. So if you have to look at a revival for India right now, what is the kind of revival are you seeing? Because, multiple comments coming in, yeah, that probably it could be a sharp V-shaped recovery. Some people have the opinion it could be a U-shaped recovery. Very interestingly, I was reading a couple of articles as well that now they're saying that we could see bouts of recovery that could come in, then a sudden fall, as you already mentioned right now, that there could be some bit of correction period that could come in, and then again an up move, which turns out to be like a W-shaped recovery. What's the sense that you have for India?
Well, I'm not, I think the recovery is still some distance away because we are not fully out of the lockdown. Economic activity is picking up, but it hasn't fully picked up, and the number of cases of COVID are rising. So I think India is definitely going to see a contraction in GDP over the next 12 months. So when you talk about a recovery, it's not that our GDP is going to start recovering in the next 12 months. It's going to be more of a contraction, and the data coming out isn't going to be showing like positive or hugely positive recovery type numbers. So when the recovery is going to probably only happen 12 to 18 months from now. And by then, we hope that there'll be a vaccine and a proper cure. But in the interim, I think we're going to have a slow period of growth. And even if the business is open, and I'm on several boards, and we're seeing business activity is resuming, but there are labor shortages because a lot of migrant laborers have gone back and they don't want to come back to work. So companies have to reorient their hiring and become more local and design some of their systems as to how they're going to work, whether they'll work from home, etc. So all of that adjustment is going to take some time.
Right. And with all of this, Punita, as you already spoke about emerging markets where India has actually underperformed in the month of May. Where would you actually place India from here on if you have to place your bets in terms of priority of investments? And do you think there is a possibility where global investors will look at India first versus China?
I think strategic long-term investors that are looking to are mostly corporates that are looking to build out diversify their supply chains and build out other sources of manufacturing are definitely going to look at India longer term. And we see that happening in pharmaceutical, chemicals, and those kind of sectors. So there is a longer term benefit that India is going to gain on the manufacturing side. But we are also seeing that, you know, companies around the world are also trying to become more local in their own home countries. So even in US, they're trying to bring manufacturing back to the US. So there's going to be a realignment of all supply chains. Even Indian companies sometimes are importing components, and they're finding that that's proving to be quite difficult. And one reliance on one component can really disrupt your entire supply chain and your entire manufacturing. So they're going to also try and put some more manufacturing in India. So every country is going to add more manufacturing capacity as a result, including India.
Right. So with this, do you think that there is still a little more confidence that FIs will have about India versus China with what's happened? Because all this while, Punita, we've always looked at China as the manufacturing hub, for the globe, versus India has always been known as the back office hub. Now, when things are changing on the supply chain, as you're mentioning about the realignment as well, that could be happening, is there a possibility where if you have to again place your bets between India and China, there is a little bit more confidence on India?
If you look at just from an equity market perspective, the weightage of China in the indices is far higher than India. I mean, and even if you look at like just the Asia Pac index, ex-Japan, India is about 10% of the index, roughly speaking, and China, Hong Kong is more like 30 to 35%. So just in terms of in that ratio, of course, China will always get, and Hong Kong will always get more capital compared to India. And at the moment, the COVID situation has, obviously China is now past the COVID, and the companies, including retailers, have opened up. Even for instance, Apple stores China was the first country that shut, and then the first country that they opened. So economic activity is in better shape in China, and as a result, investors are still investing in China. And if you look at the markets, the Chinese markets and the Hong Kong markets have outperformed the Indian markets. But at some point, the valuation disparity between India and some of the other EM markets and the other developed markets will start to look attractive again. I mean, some of the valuations already of Indian companies is now beginning to look on a price to book close to what you've seen in previous economic crises. So valuations will always drive flows. Growth is obviously a concern in India. So I think it's going to be more value investors that I see coming into India. Growth, of course, the demand side and the supply side are both kind of a little bit disrupted at the moment. And so that'll take some time for things to normalize.
Right. Interestingly, when you just mentioned about the price to book, as well as in terms of valuations as well, we were just having a conversation yesterday where we've been looking at the market cap to GDP ratio, Punita, and the historic 10-year average of the market cap to GDP ratio for India has been somewhere in the range of around 75 to 76%. Now, currently, if you see the market cap to GDP ratio, that's around 60 to 62%. So, and with that, if you see, the markets are yet not at the bottom, because at the bottom, probably when the P multiple was say around 10 times, at that point in time, the market cap to GDP ratio was somewhere in the range of 40 to 45%. So there is some bit of room still left. With these kind of multiples, do you think staggered investments should be the way forward from here on for any of the investors?
Yeah, I think if you are a long-term investor and you're investing through SIPs or averaging kind of on a regular basis, averaging down or up, that will smoothen out your cost basis, and you should definitely consider doing that. Now, interestingly, India is still a closed capital account economy, and therefore Indian investors, institutional, retail, don't have too many options of investing outside of India. So that protects the downside to some extent, because you have a large base of investors that are captive to the Indian markets. And those are the ones that have been investing. The foreign investors are more fluid, they come and go. Over the last 1 month, we've seen foreign investors too coming back into the Indian market. although for the full year there have been outflows. And part of the reason is that valuations are now beginning to look attractive selectively. Of course, growth is very uncertain still. And so on that basis, you can't even be sure of valuation because but a number of companies now are trading at just the prices that we've seen 7, 8, 9 years ago. And so, and in that period, they definitely have grown. So in many companies, evaluations, even on historic levels, are attractive, and going forward will hopefully over the next 12 to 18 months, things will start becoming more normal.
Right. And, I mean, how much more pain, Punita, are you seeing that could come in, taking into consideration that, okay, currently there is a possibility that markets, in terms of the bottom, probably could be determined on the back of the medical solution that comes out, or even the interplay of monetary as well as fiscal stimulus. So how much more pain are you expecting? Because we've already hit lows of 7,500 in the month of March. Do you think there is a possibility that Indian markets could actually again go down to these kind of bottoms?
It's very hard to tell in this environment, but I do think markets could be volatile. And again, if there's a cure or any good news on COVID, the numbers in India and the economic activity, then things will start rebounding more sharply. And if the data is negative, so I think it's going to be very data dependent. If you look at historically, the markets in previous crises, including 2008, etc., have traded at lower multiples than what the multiples are today. But that is an across-the-board statement. But in terms of individual companies, there are some companies that are already at those kind of valuations. So I think one will have to be very stock-specific as well as watch the data.
Right. And with this data, if you're looking at India, as you just mentioned, on the back of valuations, yes, we will see a lot of interest that comes in. What are the sectors that emerge as opportunities in these times of distress if you have to look at the Indian markets?
See, right now, of course, all across emerging markets, the sectors that have outperformed are healthcare and communication services, and to some extent, some consumer-oriented companies. I think as a recovery happens, there will be a shift a little bit towards more cyclical companies, some consumer discretionary, which have been really hurt by the lockdown. And as those companies are able to resume, for instance, in the US, as the lockdown has been easing, we are seeing the retailers, the stocks of a lot of retailers rebounding quite sharply. So if you just look across where the rebound has been the sharpest after the lockdown in the US, it has been in companies that have been very dependent on consumer discretionary spend. And I suspect that we would see some of that happen in other countries, including India as well.
Right. And with all of these sectors, if you have to look at an investor rejigging his portfolio, there has been a lot of fear right now, and there is a lot of panic selling also that creeps in the moment we start going down. Gold is something as an asset class, Punita, which has been really making new highs. Real estate is emerging as an investment bet as well. I mean, as a safer bet probably, though there will be slow growth on that front. So if someone has to look at an investment portfolio at this juncture, say with 100 rupees, how would you advise the investor to break up the allocation?
It depends on, I mean, of course, it all depends on your risk tolerance, what your age is. India is a young population, so I think long-term equities have always delivered returns. So if you're young, then you can take more risk than compared to if you're older. Right now, of course, a lot of investors have been moving towards bonds, and it depends again on your risk tolerance, and gold and asset. So I think you have to have a mix, a balanced portfolio. You can't be all equities and you can't be all gold. So you have to be balanced. And generally, if you look at target date funds, they're based in the US and developed markets. Particularly in the US, we have these age-based funds, which are based on your retirement, and the mix of equity and debt and gold and whatever else changes. So I can't give you one answer because it all depends on everybody's individual circumstances.
Right. And Punita, any sense that you're picking up in terms of crude? I know this is just a very different question. I'm coming on this one because what's happening with crude right now, everyone's talking about that $30 is actually the new $100 for crude right now. Do you think that's something which will hold on, or do you think we will again be back to those levels of $80, $90 per barrel?
See, I'm not a
I
commodity
know.
trader and I
That's
don't
exactly.
follow commodities. So my answer is going to be just an educated guess, like everybody else. And I think crude definitely is linked to economic activity. And as the economic numbers come out more positive, potentially, right now we've been in a lockdown. We haven't even had a lot of demand. Cars haven't been running, businesses haven't been using. So I think to some extent, as demand picks up, maybe there'll be a recovery. But again, I am not an expert on this.
Right. Punita, we'll start taking a couple of questions that have started to come in. The first question is coming in from Namit Arora, who's asking, what are your thoughts on likely further action by the Fed from here on?
Well, I think given that this is an election year in the US, the government, the president, and the Fed are going to do whatever it takes to make sure that the economy is stable and that they are willing to print as much as is required. So I would say that there's no shortage of further stimulus if required.
Right. Another question coming in is, besides perception, what has changed to drive markets higher?
What has changed is, yes, I mean, one, that we have understand COVID a little bit better, and that at least in countries like China, we've seen that the curve is flattened. In the US, we've seen the curve is flattened. In India, it is still on the rise. So there is one change. You know, we were hit by a pandemic and nobody quite knew what was going on. Now we have got some sense of how to handle it. And now, you know, the economies are opening up. But again, you know, if there's a second wave and all, you may have another lockdown. So that's why I think that a lot depends on what happens in terms of vaccines and cures. But what has changed is that at least we are better prepared today. And there's been a lot of stimulus to counter whatever economic pain that we've seen. And it won't fully ease it, but it'll go a long way.
Right. Another question, Punita, that has come in is with regards to the earnings. Now, earnings is something which we're not really able to justify at this given point in time. And markets are yet to even look at Q1 FY21. You know, from a financial year perspective, do you think they're already pricing in, or it will be a catch-22 situation where the markets have to yet price in Q1 FY21 earnings, and that's when we could hit another bottom if cases peak as well with COVID, and that's going to be a double whammy?
I don't know. I mean, the earnings are definitely uncertain, and I don't think even the managements quite have a handle on what the earnings might be for this quarter. But there is the data coming out from companies in this quarter isn't going to look pretty. And in some companies, the valuations may be discounting that, and in some companies, they may not be, which is why I said you have to be very selective. And every company's ability to handle the COVID and their financial situation and their ability to take on more debt or whether they have cash reserves is going to be something that needs to be closely watched.
And another question coming in is, Punita, what are the parameters that FIs typically look at before entering the Indian market? There are any specific ratios that they keep an eye on?
Well, I think one of the things that FIIs have been started looking at quite a lot is the rupee dollar, because the currency has been a big disappointment. So while people have made over the last 5 years, 10 years, they've made returns in local currency terms. In dollar terms, a lot of that has been reduced by the weakness in the currency. So at the moment, of course, any times of crises, people always flee to safe haven assets. And therefore, a US dollar and the US markets have been where all the action has been. But slowly, I think US markets are now only like 5-10% below their peak. And the earnings data coming out this quarter may not look good. So US is a little bit vulnerable unless they keep pumping more money. So people will start looking at other economies, and we've already started seeing FIIs come back to India. But yes, I think one of the things they do watch are, you know, valuations and of course the currency.
Right. And lastly, with regards to banking sector, that has been the driver of the economy, flushed with funds, still beaten down to death almost. What is the future of the sector according to you?
Well, the financial sector, again, the strong companies are going to survive. The weaker ones is going to be a consolidation because they are going to see NPAs rise in this environment. And so safer is better in terms of the kind of companies that you invest in. Valuations, of course, financials have been a big underperformer. And of late, in again, if I look at the rotation in the US and others, financials have started to perform. And there has been, so again, I would suspect that would again happen in India as the economy and economic activity resumes. But you have to be careful because NPAs will rise.
Correct. Correct. Yeah, that's the anticipation as well, what everyone is looking at right now, because businesses have actually come to a standstill. But I think all our questions have also been answered. Thank you, Punita, for joining us on the show. I hope you enjoyed the conversation as well. We will come back to you once things improve. And thanks for giving us this time. I know you were unwell slightly some hours ago, but hope you do keep safe and you're
Thank
fine
you.
after a
Thank
bit
you
as
very
well.
much.
Thank you, Punita.
Bye.